Thank you to Aaron Clark with Dart Bank and Wayne Lacey with Cherry Creek Mortgage for joining us today to give us a lending update. As always with the roundtables, they are being recorded and we will be sharing them with you later in our private Facebook group. This is also streaming on Facebook Live. If you have any questions, please throw them up in the chat or the Q&A section, and we will be moderating those and feeding them over to our panelists. So with that, we will get started here. And I'll give you guys questions and you can kind of bounce them back and forth to each other if you'd like. So my first question is, what can realtors and consumers expect of the mortgage process now? Is there anything different prior to before when shelter in place went into effect? Are you encouraging only online applications? What can people expect now that we have some people sheltered in place, some industries are back to work? Aaron, Wayne, if you guys want to both address that.
Yeah, go ahead, Aaron. You're muted.
Aaron, you're muted.
Right, it's that technology thing. So the question was, what's different as far as the process from the customer standpoint? Was that the basic question?
Correct.
Okay. I mean, really, from our perspective, purchase business has not really changed. You know, time frames, we prioritize purchases to make sure that we can accommodate those time frames. Really the biggest thing is, well, there are two, I guess. You know, we are getting a lot of appraisal waiver options for clients on a purchase transaction. I do have a lot of clients that are still choosing to get an appraisal. You know, the other big thing that we're running into are changes in their job status. And, you know, it's no control of theirs, but, you know, with all of the employers, you know, furloughing and laying off, it seems to be a bit of a challenge for those clients that are having that happen to them. And it can completely change their approval status, unfortunately. So we just need to make sure that we communicate with the clients and stay on top of that. Wayne?
Yeah, I'd agree with Aaron as far as process is concerned. I mean, the difference is more about the experience than anything else, because at least I traditionally meet with buyers face to face as often as possible, and obviously not being able to do that has created a little bit of an adaptation to my process. But at the same time, I feel like, I mean, the reason I started doing that anyway was because of the many questions that people have, and it's just easier when you're sitting face to face and having a fluid conversation with the loan docs right there in front of you. That has created a little bit more, probably made me sharpen my saw a little bit more over this process than maybe I'm used to, because I typically only answer questions that are asked, and that meeting usually facilitated them. Whereas now I have to maybe speculate a little bit more as to what the questions might be. And then procedurally speaking, we just have to be a little better or a little bit more diligent about our pre-funding stuff that we do when it comes on every loan, and always have done, like verifications of employment, you know, being done the day before or within a 3-day period instead of 10-day period, and that kind of thing. But generally speaking, though, the process in and of itself, as long as nothing major happens outside the transaction to change it, we're not getting, you know, I'm sure they're the same way. It's not getting handcuffed or hiccuped in any other way.
Aaron, you mentioned that with people being laid off and unemployment a little uncertain for some folks now, they are losing their previously approved status. Is that something that you're seeing a lot of, or is that a smaller percentage of the people that you're working with?
No, I'd say it's a smaller percentage. You know, the biggest group that I happened to run into were obviously GM employees. So, you know, I had some of those where they were laid off, and that, you know, unfortunately there's just nothing that we can do within parameters and guidelines in order to still allow them to close. So right now we're still waiting for them to go back to work. I understand some of them might be today, but then the next challenge is to how do you verify they're back at their same position, same hours, basically the same income that we qualified them with. Sometimes that's a bit of a challenge, especially when somebody like General Motors does subscribes to a third party to do their verification of employments, and that may not even be updated yet. So, but it's not a large percentage, but it's enough that it needs to be addressed, or it needs to be brought up out there. Wayne?
Yeah, I mean, that's a great point, because I know that in 60 days, someone that applies, we can look at that 60-day history from the day they go back to that funding date and extrapolate an income to figure it out, to make sure that they're doing it. But day one is the hardest challenge for sure. And especially a company like me, he makes a great point, and Myers the same way. You don't get an individual to write that letter for the employee because they do use a third party to verify employment. So getting that additional data that would help us make that lending decision at that point is a little bit more difficult than if they worked for, even just a car dealership where they can say, yeah, we're back to work full time and hours are regularly scheduled, and there will be no longer any kind of deficiencies in their hours or wages. So the other thing that might be that I've seen come across the pipeline is people that were pre-approved in April or even March and then took a hiatus because of everything, and their credit scores were maybe, they were like a 630, 640, even a 650. And a lot of lenders have pulled out of the government lending under 660. And so you may have a buyer that was fully pre-approved, even underwritten. Sometimes you take that file and you underwrite it because there's some questions and it gets approved. And then now they aren't, because they didn't get under contract, they didn't get locked in. The next thing you know, you're out shopping with somebody who thinks they're pre-approved. And since they went dark, we haven't followed up as much as we should, that kind of thing. So I would say that if you're talking to anybody you've been working with in the last, 45 days, I would make sure that they retouch base with whoever they're working with from a lending perspective and just verify their credit score hasn't, the credit model that they fit into is still qualified, because you don't want to get under contract on somebody who should be getting financed. It wasn't no problem before, but because of the industry changes is now no longer qualified.
Yeah, and that's where our realtor partners can really help us out, is if they know, because we don't know what we don't know. If they're made aware of any changes in their employment or anything like that, just, encourage the client to reach back out to us so that we know exactly where we're at up to date and if it's going to affect their approvability or not.
Yeah. And I don't know what the industry is going to look at. I mean, all the feedback that I've received is nobody really knows what the industry is going to look at when it comes to forbearance as well. That's another question you really need to ask your clients, especially if they're selling to buy, and make sure they haven't utilized the forbearance, because as of right now, Fannie Mae, in conversations with our operations team, Fannie Mae has said flat out that if they are in forbearance right now, then they don't qualify, because that indicates a current financial hardship. And if that's the case, and you've got a buy to sell, or sell to buy, it could change the dynamics of everything. And with, in that conversation, there's been no direct acknowledgement on whether or not the forbearance will have impact on the future approval when they're out of it. I've heard some rumors that it'll be a 12-month waiting period once you're out of forbearance for Fannie Mae to lend on it. And if that's the case, and someone took forbearance because they could, they might not be able to sell then buy right now because they took the forbearance and don't qualify.
Good point.
That's great information. I hadn't even considered that, so thank you so much for sharing. You mentioned that some lenders are not going below a 660 credit score when it comes to the FHA loans. Is that correct?
Yeah, from what I've seen, it's government loans across the board, VA, FHA, and rural development.
Have you seen any other changes to those loans? Are they processing as normal, or are they moving a little bit slower than usual?
I think they've been on time. I mean, rural development has been. I think they're only on like 24 to 48-hour turn times. I think, like Wayne said, really the biggest challenge is these investors have said, you know, these are high risk loans. You know, they have more likelihood to default than, say, a conventional loan. And right now, with the uncertainty, they don't want to take the chance. So, what, you know, they're raising their minimum credit scores, they're raising the rates, you know, so that it makes it pretty near impossible or extremely difficult to do those types of loans right now.
Yeah, they're charging, and you know, from what I've seen, the upfront fees have gone up significantly under 660. And just to put it in perspective as to why, I mean, first payment forbearance, and there's a lot of loans that closed in March that never made it, still haven't made a payment yet. And so now, you know, investors have got a loan on their hands that they're not getting any kind of return on, and they're not sure they'll be able to fix.
Right.
And when you factor, and that's across the board, I mean, that's every loan written. That's not just government loans. So it's mitigating risk at this point, from what I understand, that they're just trying to, you know, take the higher risk loans out of that pool, because every loan's a high risk loan at the moment. And, you know, just trying to slow down any potential losses.
We have a question that came in. If a pre-approved buyer that is currently renting delays or defers rent payments to a landlord, can that affect the approval status?
It can.
Yeah.
You know, I guess we don't know what we don't know, but if we're made aware of it, then it obviously needs to be addressed. We can't look the other way. And like Wayne said, they're claiming they have a hardship, you know, it causes a hardship in making their payment. So, but yet they're asking for more money. So, you know, it could, you know, depends on what we know, what program they're doing. You know, that's a tough question to answer. But I would say at the end of the day, if we're made aware that they're, you know, in forbearance or with their rent, then that would be a problem. Wayne?
Yeah, I would agree with that 100%. I mean, I have nothing to add, because you hit it. I mean, it's if it's disclosed to us, we have to evaluate it, and not every loan requires a rent verification, so there isn't a vanilla answer for that, for sure.
Right. Exactly.
Thank you, guys. Could you talk about how down payment assistance programs have been affected by the pandemic?
You know, I think I can. Aaron, you guys are still actively doing down payment, like Mishta, right?
Yeah.
Okay. So for him, as far as I know, and because I get the same, we're a Mishta lender as well. And there hasn't been any guidance from Mishta as regarding that they're pulling back on the traditional bond loan. They did pull back on the second time around, the, what do they call that? The MyFlex, I think.
I think you're right.
I never used anyway. I mean, it was not a very desirable loan, but from our perspective, from the mortgage company perspective, because of the risk thresholds that are out there in bond loans being typically 100% plus loan to value relationship, and the uncertainty of first payment forbearance and of that whole dynamic that I've already discussed, companies like mine are pausing on them right now, because if that loan goes into first payment forbearance and the bond loan does not want to buy it, we don't have anywhere else to send it. So companies like ours we're on pause. I can't say that across the entire industry of the mortgage banking side, but it is something that is pretty consistent across the board, because we don't have an investor to buy that loan if in fact Mishta says you didn't do something right, and we don't want that loan on our books because it's 105% loan to value, and there's nothing we can do with it. So until this whole thing kind of wraps up, we're going to be on hold from the down payment assistance loan.
We're still doing Mishta. I mean, to my knowledge, there are no changes as far as that goes. Again, most of those are being done with some type of government loan. So, Mishta sets their own parameters as far as the minimum credit score and the interest rate. So as long as it meets that, we would have no problem doing them.
Great, thanks. Can you talk about what rates are looking like right now?
They're good.
Yeah. It depends. Again, it depends on the program. The government loans, you can't get them.
Right.
And conventional loans, I mean, you're still talking, I guess it depends on what your loan purpose is and your credit score and your loan to value and all of that comes into play a little bit. But they're still extremely low. They're still extremely low. And honestly, I don't really see them, maybe creeping up. I guess I haven't really seen too much as it, there actually hasn't been too many forecasts, I guess, just because of the uncertainty of the market. Wayne, I don't know if you've seen any rate forecasts, but I don't know how you would forecast it with the market being so volatile.
Exactly. And it's all speculation because when you look at all the economic drivers like the 10-year and MBS trading, there's no reason that we're at where we're at. I mean, I think we should still be lower, technically, economically speaking. We should be lower than what those indices indicate. But we're not because of all the other outside influences that are impacting our business right now. I did, to put it in perspective as to why rates are being risked the way they are right now, as of last Thursday, according to the Mortgage Bankers Association, 7.5% of all mortgages were in forbearance. Where, to put that in perspective, on March 3rd, it was 0.25%. So, I mean, it's a huge, huge impact on these servicers that are taking payments. And as previously discussed in other calls, those servicers still have to make payments on behalf of the borrowers. So when it comes to like mitigating risk and trying to maintain margins, that's what they're doing. I mean, that's once this whole thing blows over, if nothing else changes economically speaking from the 10-year and all the other stuff, I mean, I would see a pretty significant drop in rates, but who knows when all that's going to change, I mean, 7.5% is a big, big number. I did hear some rumors last week through some of the services that I partake in that the government's going to close the window of forbearance at the end of the month. It hasn't been announced. It's not official. It's just speculation. But if they do, that at least lets us get our footing again and start funding loans after the 31st in a way that we funded them before the forbearance was even allowed.
And the Fed is still buying.
Yeah.
So, when they curtail that, it'll be interesting to see what happens if rates actually go up or what the situation is there too.
Thank you. If you guys have any questions, please put them in the chat or the Q&A, and we will pass them on to Aaron and Wayne. Did you guys see an increase last week in applications with realtors being able to leave the house again to go back to work?
I was busier. I mean, I would say I got the applications did go up a little bit, but I spent a lot of time, or as much time, fielding calls from those that were on hold. I mean, the ones that didn't do anything because they really couldn't. So I guess if you combine the two, yeah.
I'd agree. I'd say actually over the weekend, there was quite an increase.
Yeah, I had a lot of activity over the weekend too, actually. not new applications for me, but it was a lot of like, hey, we're writing this offer now.
Yeah.
So we're
Yeah. And then you have to see if they're still approved.
right, exactly.
Right.
Wonderful. That's great to hear. I think that everybody is very, very happy at being able to go back out and look at houses and start getting paperwork written up. I don't see any questions that have come through the chat or the Q&A or on Facebook for that matter. Aaron, Wayne, is there anything that you guys wanted to say that we didn't cover?
I don't think so. As always, if anybody comes up with any questions, feel free to reach out to me, and be more than happy to either research or find the answer for you.
Yeah, I agree. Same for me as well. I think the only thing I could say is just like, call. I mean, if you just call, don't. These are unprecedented times for what we're dealing with as an industry when it comes to changes on the daily. So if you have a buyer that you've been working with for some time, I would say we should refresh that conversation before you spend a ton of time out doing more.
Right.
And just save everyone a lot of heartache.
Yep. Great.
All right. Well, thank you, Aaron and Wayne, for joining us and sharing all of this great information with us today. I want to remind everyone we will have another digital roundtable tomorrow. However, it will be at 9 o'clock in the morning, and it will be with a local nurse who is going to go over best practices for staying safe while we are all out there working. So please look forward to that link and join us tomorrow. Aaron, Wayne, thank you again, and everyone have a great day.
Thank you, you too.